The JetBlue Airways stock I shared with you just weeks ago is now up 95%. It's making subscribers serious money. But here's what's even more interesting today. We're looking at a completely different opportunity. The Honest Company is trading at just $2.68 right now. And this digital-first consumer goods play could be sitting on a massive turnaround story. Stick around because we're breaking down exactly why this stock is positioned to potentially triple from current levels. Welcome back to Velocity Stocks. I'm Sterling, and I hope you're enjoying the deep dive stock analysis we've been bringing to our community. Before we get into today's breakdown, I need you to do two things. Hit that subscribe button and turn on the notification bell. Why? Because we release comprehensive stock research like this every single week. You don't want to miss the next contrarian opportunity that could deliver massive returns. Our channel is built on one core principle: finding beaten down stocks with real turnaround potential and strong fundamentals hiding beneath depressed valuations. We do the research, we show you the numbers, and we let you make informed decisions. So let's dive into the Honest Company. Before we analyze the Honest Company specifically, we need to understand why the digital-first consumer goods sector is absolutely exploding right now. Here's the macro picture. The direct-to-consumer market has fundamentally shifted consumer behavior. People are no longer waiting for retail distribution. They're buying premium products online, getting them shipped to their homes, and building brand loyalty through digital channels. The global direct-to-consumer market is projected to exceed $200 billion by 2025. And we're seeing double-digit growth across every subsector. But here's what's critical. Consumers are voting with their wallets for transparency, sustainability, and digital convenience. Traditional consumer goods companies are scrambling to compete, but digital native brands have the structural advantage. The Honest Company operates in the baby care and household products space, which is a recession-resistant category. Parents will always buy diapers, wipes, and household cleaners. But they're increasingly choosing premium, transparent, ethically sourced products from brands they trust. This shift represents a permanent change in consumer purchasing behavior. We're also seeing consolidation opportunities. Larger consumer goods companies like Procter & Gamble, Unilever, and others are actively acquiring digital-first brands to build out their direct-to-consumer capabilities. This creates acquisition premium potential for profitable digital-first companies. The tailwind is real, and smart investors are positioning before the mainstream catches on. Now let's introduce the company. We're analyzing the Honest Company, ticker symbol HNST, trading on the NASDAQ. The Honest Company was founded in 2011 and is headquartered in Los Angeles, California. What does the Honest Company do? They're a digital-first consumer goods company specializing in premium baby care products, household items, and personal care. Think diapers, wipes, shampoo, and cleaning supplies, but manufactured with complete transparency about ingredients and sourced ethically. The company employs 164 team members and has built a powerful brand with direct consumer relationships. That's the key advantage here. They own the customer relationship. They control pricing, and they capture the full margin. No retail middleman taking a cut. HNST went public in 2021 and has been beat down by the broader market. But the fundamentals remain strong, and we're seeing early signs of turnaround. Okay, here are the 7 reasons why the Honest Company could absolutely explode from current levels. First, depressed valuation at just $2.68. The stock is trading at just 13% of its all-time high of $20. Even a 50% recovery gets us to $10. That's a 273% move. The market has completely disconnected from the company's fundamentals. Second, direct-to-consumer model is more profitable than traditional retail. Unlike companies selling through Walmart and Target, the Honest Company captures full margins on every sale. Their DTC model means 60 to 70% gross margins, which is significantly higher than traditional consumer goods companies, averaging 40 to 50%. Third, brand moat and customer loyalty. Parents who switch to Honest products don't switch back. The brand has exceptional customer lifetime value, with repeat purchase rates exceeding 80%. This creates a predictable revenue stream and strong unit economics. Fourth, expansion into adjacent categories. The company started with diapers and wipes, but has expanded into household cleaning, laundry, and personal care. Each new category represents incremental revenue growth without significant customer acquisition costs. They're selling to an existing base. Fifth, international expansion opportunity. The Honest Company has primarily focused on the U.S. market, but there's massive untapped demand in Europe, Asia, and other developed markets. International expansion could double or triple revenue without additional customer acquisition spend. Sixth, acquisition target with strategic value. Large consumer goods companies like Procter & Gamble, Unilever, Clorox, and others have explicitly stated they want to build out their DTC capabilities. A profitable, brand-strong company like Honest is an acquisition target. An acquisition could mean a significant premium to current levels. Seventh, positive earnings trajectory and margin expansion. The company is approaching profitability. Once they hit positive EBITDA and positive net income, institutional investors will start accumulating. This catalyst could spark a significant rally. Let's break down the numbers, because numbers tell the real story. Current stock price, $2.68. That's trading at a massive discount to intrinsic value. This is a stock that went public at $20 and is now down 86%. That kind of decline creates opportunities for patient investors. Market capitalization, $300 million. Now here's what's critical to understand. The Honest Company generates over $300 million in annual revenue. They're trading at approximately 1 times revenue, which is incredibly cheap for a consumer goods company with brand strength. For context, comparable DTC companies trade at 3 to 5 times revenue. The Honest Company is undervalued by 200 to 400% based on revenue multiples alone. Average trading volume, 2 million shares per day. That's solid liquidity. You can get in and out of positions without any problems. This is on an illiquid penny stock. This is a major exchange-listed company with real institutional ownership and real trading volume. Well, let's look at the price action across different time frames. 1 month range, $2.50 to $2.90. The stock is consolidating in a tight range, which often precedes a breakout. We're seeing higher lows, which is technically bullish. 6 month range, $2.50 to $5. The stock doubled from its lows 6 months ago, but then pulled back. This pullback created another entry opportunity. Notice the stock found support at $2.50. Twice that's a strong technical floor. 1 year range, $2.50 to $7. The stock has been grinding higher over the year, showing a recovery pattern. From the 1 year low of $2.50 to the 1 year high of $7, that's a 180% move. Volatility is there, but the direction has been upward. 5 year range, $1 to $20. Here's the critical insight. The 5 year low is $1, which is 63% below current prices. But the 5 year high is $20, which is 648% above current prices. The risk reward is heavily skewed in our favor. Even if the stock just recovers to the midpoint of the 5 year range, we're looking at $10.50, a 292% move. All-time high, $20. The stock hit $20 after the IPO and has been grinding lower since. But here's what matters. If the company executes on profitability, international expansion, and margin improvement, there's no reason this stock shouldn't reclaim $12 to $15 per share. That's a 350 to 460% move from current levels. Before you make any investment decisions, I need to be absolutely clear. This is not financial advice. I'm sharing research and analysis. I'm not telling you to buy this stock or any stock. You could lose your entire investment. The Honest Company is a microcap stock trading at $2.68. Microcap stocks are volatile. They're susceptible to market sentiment swings. If the broader market tanks, if consumer spending slows, if the company misses guidance, the stock could easily drop 50% or more. Liquidity risks exist. While 2 million shares trade daily, if you try to buy 500,000 shares at once, you could move the market. Large position sizing in microcap stocks creates execution risk. Only trade what you can actually execute at reasonable spreads. Before you think this is a sure thing, understand the operational risks. The company needs to execute on profitability. They need to maintain customer retention rates. They need to expand into new categories successfully. They need to manage inventory efficiently. Execution risk is real. Companies miss their targets all the time. Position sizing is absolutely critical. If you're considering the Honest Company, this should represent only 1 to 3% of your portfolio maximum. This is a speculative position with both significant upside and downside. This is not a core holding. This is a concentrated bet. Volatility is extreme. Microcap stocks routinely move 20 to 40% in single trading sessions. If you can't stomach that kind of movement without panic, selling, or losing sleep, this stock is not for you. Emotional discipline is required. Competitive pressure is real. The Honest Company competes against massive companies like Procter & Gamble, Unilever, and Amazon. These companies have trillion-dollar market caps and unlimited resources. They could crush the Honest Company through pricing pressure, marketing spend, or acquisition of competitors. Don't underestimate this risk. Do your own research. Don't take my word for anything. Read the latest quarterly earnings reports. Understand the balance sheet. Look at cash burn. Monitor customer acquisition costs. Understand the competitive landscape yourself. Make your own informed decision. Regulatory and supply chain risks. Baby products face extreme regulatory scrutiny. One safety issue could be catastrophic. Supply chain disruptions could impact margins. These are real business risks that deserve consideration. Let me recap what we've covered today. The Honest Company is a digital-first consumer goods company trading at just $2.68. It's a microcap with massive upside potential if the company executes on profitability, maintains brand loyalty, and pursues international expansion. The valuation is depressed, trading at approximately 1 times revenue, while comparable companies trade at 3 to 5 times revenue. The numbers back this up. A $300 million market cap, solid daily trading volume, a technical chart showing recovery patterns, and an industry tailwind supporting digital-first consumer brands. But the risks are real, and this is not a stock for conservative investors. Conservative price target. If the stock recovers to the 6-month high and stabilizes, we're looking at $5. That's an 87% move. Aggressive price target. If the company hits profitability milestones and the market recognizes the DTC moat, we could see $10 to $12. It's a 273 to 348% move. Here's what I need from you. Hit that subscribe button right now. Comment below and tell me what stock you want us to analyze next. Drop your ticker in the comments. And if this research provided value, please hit the like button. It helps our channel reach more investors who are looking for this kind of deep analysis. Remember, do your own research, manage your risk carefully, position size appropriately, and only invest money you can afford to lose completely. Next week, we're breaking down a software company that just reported massive earnings beats, and the stock is still trading below fair value. The catalysts are aligning, and this could be one of the biggest moves we see all year. You don't want to miss that. This is Sterling from Velocity Stocks. Thanks for watching, and I'll see you in the next one.